Insurance News Report, February 11, 2026. Disclaimer: this content is for informational purposes only. It is not legal, medical, financial, or official advice. Do not treat anecdotal stories, regulatory updates, or market commentary as guidance. Always consult a licensed professional for decisions involving insurance, risk, or compliance. Report Overview. 1. Allstate announces major auto rate reductions in 12 states. Allstate confirmed it will lower auto insurance premiums across 12 states following improved loss ratios and reduced claim severity. Reductions range from 3% to 11%, depending on the state. Analysts say this signals stabilization after 2 years of aggressive rate hikes across the industry. 2. FEMA updates flood maps for 2026 cycle. FEMA released its latest flood insurance rate map, firm, updates, impacting over 420,000 properties nationwide. Thousands of homes in coastal regions were moved into higher risk zones, increasing required NFIP premiums. Conversely, 60,000 properties were downgraded to lower risk categories, reducing annual costs. 3. Cyber insurance premiums rise again. Cyber insurance rates increased 8% quarter over quarter, driven by ransomware severity and cloud infrastructure attacks. Underwriters are tightening requirements around MFA, endpoint monitoring, and incident response plans. Brokers report that companies without documented security controls face 20 to 40% surcharges. 4. State Farm faces class action over roof claims. A new class action lawsuit alleges State Farm improperly denied roof damage claims by using unapproved inspection criteria. Plaintiffs argue the insurer systematically rejected wind damage claims after 2023's severe storm season. State Farm denies wrongdoing and says its methods comply with state regulations. 5. Medicare Advantage sees record enrollment. CMS reported Medicare Advantage enrollment surpassing 34 million, the highest in program history. Growth is driven by expanded supplemental benefits, including dental, OTC allowances, and transportation. Some watchdog groups warn that aggressive marketing practices may face regulatory scrutiny in 2026. 6. Viral insurance product of the day, Gadget Gap Micro-Coverage. A new $5 per month micro-insurance plan covering lost earbuds, chargers, and small electronics went viral on TikTok. Sign UPS surged after influencers highlighted the no deductible feature. Early resale angle, promotional bundles including branded cases are reselling for 3 times retail. 7. High-value resale item, 2021 Lloyds of London commemorative coins. A limited run of Lloyds of London silver coins originally priced at $89 now sells for $350 to $420. Collectors cite the coin's rarity and insurance industry historical significance. Insurance Daily News, February 11, 2026. Global Insurance and Risk Industry Update, spoken by AI. Market Snapshot, Key Insurance Indicators. The insurance industry is seeing a mix of easing costs in some areas and rising pressures in others. Below is a summary of key metrics and trends as of February 11, 2026. Indicator. Current figure. Recent trend. U.S. auto insurance premium, average annual. $2,697, full coverage, autobodynews.com. Plus 6% versus prior year, rate hike slowing, autobodynews.com. FEMA flood map revisions, 2026 update. For 20,000 plus properties reclassified. Thousands more in high-risk zones, premiums, 60,000 to lower risk, premiums. Cyber insurance pricing, Q4 2025, U.S. Plus 8% average premium change QOQ. Continuing to rise, ransomware losses high, was double digits in 2024, now moderating. Medicare Advantage enrollment, 2025. 34.1 million beneficiaries, KFF.org. Plus 7% versus 2024, record high, 54% of Medicare users, KFF.org. NFIP flood insurance premiums, Risk 2.0. $888 average annual premium, EST. Plus 12% since 2021, new rating model phased in, higher costs for many coastal homes. Sources: NAIC, FEMA, CMS, Marsh & Brokers. Premium figures are approximate averages. Trends reflect year-over-year or quarter-over-quarter changes as noted. Allstate leads auto rate reductions after 2 years of increases. Major premium relief. In a notable pivot for auto insurance customers, Allstate announced it is lowering auto insurance rates in a dozen states, with rate reductions ranging from 3% to 11% per state. This comes after 2 years of industry-wide premium hikes that sent auto insurance costs to all-time highs. Allstate's move, affecting some 7.8 million customers, is attributed to improvements in its underlying claims costs, notably improved loss ratios, the percentage of premiums paid out in claims, and reduced claim severity in recent quarters. Essentially, fewer and less expensive accidents are allowing the insurer to give money back to policyholders in the form of lower rates. AutobodyNews.com, AutobodyNews.com. Stabilizing after a surge. From 2021 through 2024, U.S. auto insurance premiums skyrocketed due to surging repair costs, higher accident severity, supply chain issues for car parts, and a spike in catastrophic claims, like hailstorms. In 2024, auto insurance was, in fact, the single largest contributor to U.S. inflation, with the average full coverage premium reaching $2,543, up 26% from the prior year. Insurers implemented aggressive rate increases to catch up with those costs. By mid-2025, however, data showed the trend moderating. The average premium in 2025 ticked up to about $2,697, roughly plus 6% year-on-year, a far gentler rise than seen in 2024. Analysts described the auto insurance market as stabilizing after years of turbulence, with some states even seeing net premium decreases by late 2025. AutobodyNews.com, AutobodyNews.com, AutobodyNews.com. State-by-state cuts. Allstate's rate cuts exemplify that turn. For instance, in California, after a 17.7% hike last year, State Farm, California's largest auto insurer, recently filed for a 6.2% rate decrease citing fewer costly physical damage claims. In Louisiana, Allstate received approval for a 7.6% rate decrease, effective January 1, 2026, following a drop in accidents and claims costs. And in Florida, the top 5 insurers collectively cut rates 6.5% on average in 2025 after legislative tort reforms reduced litigation expenses. These examples underscore how improving fundamentals, fewer accidents, legal reforms, are now translating to premium relief in select markets. AutobodyNews.com. Industry implications. While auto insurance remains expensive by historical standards, the recent pullback in rates in certain states is a welcome relief for consumers. It also suggests that the industry has returned to profitability after the pandemic-era upheaval. Allstate CEO Thomas Wilson noted that the company's auto insurance business restored margins to target levels by late 2025, thanks to its transformation growth initiative and prior premium hikes. Now that losses are in check, Allstate can afford to compete on price again. Indeed, with this move, Allstate seems to be leaning into growth mode, aiming to retain and attract customers with more competitive rates, after having prioritized profit restoration for 2 years. Other insurers may follow suit in states where regulators approve decreases, especially if frequency, number of claims, remains low. Consumers in high-cost states should check with their agents during renewals in 2026 to see if they benefit from any rate relief. But experts caution that any broad national decline will be gradual and uneven. Industry-wide, U.S. auto premiums are still projected to rise about 7.5% on average in 2025, versus double digits prior, meaning many drivers will continue to see modest increases depending on location. For now, the biggest rate drops are concentrated in states like California, Florida, and Louisiana, locales that had seen some of the steepest increases earlier. Fool.com, AutobodyNews.com. FEMA 2026 flood maps, reclassified zones impact premiums. Flood risk remapping. The Federal Emergency Management Agency, FEMA, has rolled out its latest flood insurance rate map, FIRM, updates for 2026, an action that will impact flood insurance requirements and premiums for hundreds of thousands of U.S. property owners. According to FEMA data, over 420,000 properties nationwide are seeing changes to their flood zone designation with this cycle of map revisions. Many of these updates affect coastal and riverine communities that have grown or seen environmental changes since the last maps were drawn. The shifts cut both ways. Thousands of properties, especially in coastal counties along the Gulf and East Coast, are now newly designated in higher-risk flood zones, while roughly 60,000 properties, often in areas where new mitigation projects or updated modeling showed reduced risk, have been moved to lower-risk categories. Higher risk equals higher costs. For homeowners, these map changes carry significant insurance implications. Any property now mapped into a Special Flood Hazard Area, SFHA, the 100-year floodplain, with a federally backed mortgage will be required to carry flood insurance, typically through the National Flood Insurance Program, or NFIP. That means potentially thousands of households will need to purchase flood coverage for the first time, often costing several hundred to a couple $1,000s per year. Even those already insured could see premium increases. Moving from a moderate risk zone to a high risk zone can raise NFIP premiums substantially, though FEMA's Risk Rating 2.0 pricing system now sets rates more on home elevation and flooding likelihood than just zone alone. FEMA's Risk Rating 2.0, introduced in 2021, has already been gradually raising rates for many high-risk properties. The average NFIP premium is around $888 annually and climbing about 12% per year under caps. Newly rezoned homeowners can often initially qualify for FEMA's newly mapped discount on premiums, softening the blow in the first year, but their rates will then increment up each year until reaching the full risk cost. Agents.flow, smart.gov. Premium relief for some. On the flip side, about 60,000 properties nationwide have been downgraded to a lower risk category, e.g., moved out of the 100-year floodplain to a 500-year zone. Owners of those homes could see significantly lower NFIP premiums going forward. If they no longer are in an SFHA, lenders might even drop the mandatory coverage requirement, though maintaining some coverage is still advised. These changes often reflect new infrastructure, like improved levees or drainage systems, or updated flood modeling that shows less exposure than previously thought. For example, FEMA recently released draft updated maps for Harris County, Texas, Houston, the first major update there in nearly 20 years, which expand the high-risk floodplain to mirror realities observed during Hurricane Harvey. Such expansions in one area might be offset by improvements in another, a new dam or diversion lowering risk downstream, etc. Overall, the 2026 map updates underscore how dynamic flood risk is due to development and climate patterns. Yahoo.com. Homeowner to-dos. FEMA's updated firms will not become effective immediately. Once finalized, communities get a 6-month adoption window. Homeowners should check the new maps, available on FEMA's Flood Map Service Center or through local floodplain administrators, to see if their property's zone changed. If you were added to an SFHA, talk to your insurance agent about securing an NFIP policy before the maps go into effect. Doing so may lock in more favorable rates. Conversely, if you were removed from high risk, consult your lender. You might be able to drop coverage or at least enjoy lower premiums, though be mindful that Mother Nature doesn't always follow FEMA's lines on a map. Flood experts note that 25% of flood insurance claims come from outside high-risk zones, so maintaining some protection can still be wise. For policymakers, the large scope of changes, hundreds of thousands of properties, reinforces ongoing debates. As flood risks increase in some areas and mapping struggles to keep pace, there's mounting pressure to update infrastructure and possibly mandate broader flood coverage adoption beyond just SFHAs. Click to Houston.com, financialcontent.com, financialcontent.com. Cyber insurance, rates climb amid ransomware wave. Premiums up again. Cyber insurance continues to be a challenging market for businesses, as evidenced by another quarter of premium hikes. Industry reports show that cyber insurance premiums rose roughly 8% in Q4 2025, quarter over quarter, for U.S. policyholders on average. While less drastic than the double-digit quarterly jump seen in 2021 and 2022, this persistent upward trend keeps cyber coverage prices near all-time highs. By some measures, overall cyber insurance pricing has roughly doubled since 2020, though the rate of increase began moderating in late 2024 and into 2025. For context, some analyses actually indicate cyber premiums peaked and even dipped slightly, -3% to -5%, in late 2025 for well-secured clients, but many organizations, especially those without top-tier security, are still seeing price increases at renewal. The 8% QoQ rise figure suggests that on balance, underwriters are continuing to raise rates, albeit more selectively. BeInsure.com, RiskaNDinsurance.com, RiskaNDinsurance.com, BeInsure.com. Ransomware and cloud attacks, the key drivers of costly claims, and thus premium pressure, remain ransomware attacks, business email compromise, and other cyber breaches. Ransomware, in particular, has evolved into a multi-billion-dollar criminal industry that routinely forces insurers to pay large extortion demands or incident recovery costs. Although cyber defenses have improved, the proportion of companies paying ransoms has fallen, with only 20% of incidents resulting in ransom payment in 2025 versus 60% in 2019. The average size of data breaches and business interruption losses has grown. Additionally, cloud infrastructure attacks and supply chain hacks have emerged as major concerns, incidents where a compromise of a cloud service provider or software vendor can cascade to dozens of client companies. Such events, e.g., the notable cloud platform breach in mid-2025 that impacted multiple Fortune 500 firms, are raising alarm for insurers due to accumulation risk, many claims from one event. Consequently, reinsurers have started capping their exposure to widespread cyber events, which in turn keeps primary cyber insurance prices high. RiskaNDinsurance.com. Stricter underwriting, MFA or bust. Insurers are responding not just with higher premiums but with much stricter underwriting requirements. Many cyber insurers now require firms to demonstrate robust security measures in place, or else coverage will be denied or sharply surcharged. These measures include multi-factor authentication, MFA, on email and critical systems, advanced endpoint detection and response, EDR, software on all devices, encrypted backups, employee security training, and written incident response plans. According to cybersecurity legal experts, the mantra in the industry has become no MFA, no coverage. Indeed, there have been cases of claims denied because the victim company failed to utilize MFA, which was a condition of their policy. One survey found that over 50% of businesses had to implement MFA just to qualify for or renew cyber insurance in 2025. Insurers are also scrutinizing companies' network diagrams, cloud configurations, and even conducting their own scans of applicants' systems for vulnerabilities. AboveTheLaw.com, AboveTheLaw.com, JumpCloud.com. Surcharges and coverage gaps. Companies that don't meet the ever-tightening security standards are often still offered policies but at significantly higher premiums, sometimes 20 to 40% surcharges on top of base rates, or with reduced coverage limits for certain risks. For example, an insurer might still insure a company lacking an endpoint monitoring system, but exclude any claim arising from a malware infection that better endpoint security could have prevented. Brokers report that some smaller businesses are essentially priced out of comprehensive cyber coverage due to these factors, at a time when they arguably need it most. The bright side is that for organizations with strong cybersecurity, MFA, updated systems, regular backups, etc., the market is somewhat stabilizing. Competition among insurers increased capacity in 2025, and such companies even saw slight premium decreases or opportunities to expand coverage for the same cost. Overall, cyber insurance remains a critical but costly safeguard. Analysts predict single-digit percentage price increases will persist through 2026, unless a severe wave of attacks prompts another spike. Businesses and law firms are advised to treat cyber risk mitigation as a top priority, not just to reduce the chance of an incident, but also to maintain insurability and manage insurance costs. BeInsure.com, BeInsure.com, AboveTheLaw.com, AboveTheLaw.com. Litigation Watch, State Farm's roof damage claim dispute. Storm of lawsuits. Insurance giant State Farm is facing a wave of litigation over its handling of homeowners' roof damage claims from recent storm seasons. A newly filed class action lawsuit, and numerous individual suits, allege that State Farm systematically denied or underpaid roof replacement claims following major wind and hailstorms in 2023. According to the complaints, State Farm adjusters utilized unapproved inspection criteria that had the effect of classifying legitimate storm damage as wear and tear or cosmetic, thereby allowing the insurer to deny full payouts. In Oklahoma alone, more than 100 families have sued State Farm with claims that it schemed to deny hail damage claims and pocket billions by shortchanging customers on roof repairs. Lawyers involved in the case have uncovered internal communications suggesting that field offices were pressured to preemptively rule out full roof replacements, even when policyholders had extensive damage. K4.com, K4.com. Alleged claims manipulation. One specific allegation is that State Farm only reimbursed for removing one layer of shingles when many roofs had 2 layers, thus underpaying each claim by a few $1,000s in disposal costs. To an individual homeowner, that might look like a modest shortfall, but across tens of thousands of claims it could save the insurer significant money. The lawsuits also claim that after a particularly severe hailstorm, State Farm instituted a policy of pre-denying roof claims, essentially instructing adjusters to default to denial unless damage was overwhelmingly obvious. In legal filings, examples are cited where homeowners with documented large hail impacts had their claims denied or only partially paid, forcing them to either pay out of pocket or live with damaged roofs. Some of these cases, when brought to court, have led to sizable settlements. In one Oklahoma case, NIDA versus State Farm, confidential settlements averaging around $3 million per household were reportedly paid, far above the $20 to $30K cost of a roof, suggesting plaintiffs uncovered troubling internal practices in discovery. Classaction.org, K4.com, K4.com, K4.com. State Farm's response: State Farm vehemently denies any systematic wrongdoing. In a statement, the company said, every claim is unique and handled on its individual merits. The fact that someone files a lawsuit does not mean the allegations are true. We look forward to presenting the facts supporting our claim decisions in court. State Farm maintains that it followed state insurance regulations and its policies in adjusting roof claims, and that in many cases, damages did not meet the policy threshold for full roof replacement. Industry experts note that roof claims often spark disputes because policies sometimes contain depreciation schedules or cosmetic damage exclusions that are subject to interpretation. What one roofer deems a total loss, an insurer might consider reparable. However, the breadth of similar accusations against State Farm, across multiple states and storms, has put a spotlight on its claims practices. Regulators in a few states have also reportedly opened inquiries into whether insurers, State Farm and others, applied overly strict criteria for hail damage in 2023, given the unusually high volume of storms that year. K4.com. What homeowners should know: if you filed a storm damage claim that was denied or underpaid, consumer advocates suggest reviewing your policy and the adjuster's report closely. You may request a second inspection or hire a licensed public adjuster for an independent opinion. The State Farm cases illustrate that persistence can pay off. Some homeowners eventually secured far larger payouts after challenging the initial denial, either through internal appeals or litigation. More broadly, this situation underscores the importance of understanding your homeowner's coverage. Does your policy have full replacement cost coverage for roofs? Are there cosmetic damage exclusions or a separate wind/hail deductible? These factors can significantly affect claims outcomes. The class action suit could take months or years to resolve, but its progress will be closely watched. A ruling or settlement in favor of policyholders might lead to reimbursements for many customers and potentially changes in how carriers handle roof claims. Until then, State Farm and the plaintiffs' attorneys are gearing up for what could be a high-stakes legal battle in 2026. Medicare Advantage enrollment soars, alongside marketing scrutiny. Record MA enrollment. The Medicare Advantage (MA) program, private managed care plans that provide Medicare benefits, continues its explosive growth. The Centers for Medicare and Medicaid Services (CMS) reported that Medicare Advantage enrollment has surpassed 34 million beneficiaries as of early 2026, the highest in the program's history. That means about 54% of all Medicare-eligible seniors are now on Advantage plans rather than traditional Medicare, up from roughly 45% just 3 years ago. This milestone reflects a decade-long trend of seniors increasingly opting for MA plans, which are offered by insurers like United Healthcare, Humana, Aetna, and others. Despite some forecasts that enrollment might plateau or even slightly dip in 2026 due to insurer adjustments, the latest figures confirm that 2025 saw robust growth, roughly plus 7% enrollment year over year. KFF.org. What's driving the growth? Why are so many seniors choosing Medicare Advantage? One big reason is the attractive supplemental benefits these plans often include. Unlike standard fee-for-service Medicare, most MA plans bundle in extras such as dental, vision, and hearing coverage. Nearly 98% of plans offer these now, as well as perks like gym memberships, over-the-counter drug allowances, and meal delivery after hospital stays. For example, in 2025 about 73% of plans offered some quarterly allowance for OTC health items. In 2026 that's slightly down to 66%, but still a majority. Many plans also cover non-medical benefits like transportation to medical appointments. About a quarter of general plans, and 2/3 of special needs plans, provide ride benefits. These extras, combined with often low or $0 monthly premiums, 67% of MA plans have no premium beyond the standard Medicare Part B premium, make MA plans very appealing. Essentially, seniors can get more coverage for often less out-of-pocket cost, in exchange for agreeing to a plan's provider network and prior authorization rules. Surveys show those added benefits and potential cost savings are top reasons beneficiaries give for picking MA. KFF.org. Regulatory eyes on marketing. However, this rapid enrollment growth has drawn regulatory scrutiny, particularly around how Medicare Advantage plans are marketed to seniors. Federal regulators and watchdog groups have voiced concerns that some marketing tactics used in recent years have been misleading or overly aggressive. The HHS Office of Inspector General in late 2024 issued a special fraud alert detailing problematic practices, fake or deceptive mailers and robocalls, confusion tactics implying certain doctors or benefits that don't actually exist in a plan, and high-pressure sales targeting vulnerable seniors. In fact, CMS tightened rules for MA plan telemarketing in 2023 and 2024 after a surge in complaints, requiring call recording, standard disclaimers, this is a solicitation for insurance, and banning certain celebrity-driven TV ads that purported to offer free benefits. Watchdog groups like the Center for Medicare Advocacy have also flagged how some brokers may enroll seniors in plans that aren't the best fit, through incomplete information or incentives. DJHoldLaw.com. For 2026, CMS officials signaled they will closely monitor MA enrollment to ensure it remains driven by genuine beneficiary choice and not by deceptive marketing. There's also rising scrutiny on network adequacy and denials. Recent reports found some MA plans have high rates of denying or delaying care authorizations compared to traditional Medicare, prompting questions if plans are sometimes prioritizing profits over patient care. Despite these issues, overall satisfaction with MA plans remains relatively high in surveys, and the value proposition, more benefits, caps on out-of-pocket costs, continues to attract seniors. The industry's main trade group, Better Medicare Alliance, emphasizes that average MA premiums for 2026 dropped to about $14 and that plans remained popular for delivering comprehensive care at lower costs. Still, consumers should be diligent. During open enrollment, compare not just premiums but also drug formularies, provider networks, and the specifics of those extra benefits, which can vary widely in scope. And be wary of any marketing that sounds too good to be true. The bottom line, Medicare Advantage is now the dominant form of Medicare, and with that status comes increased oversight to ensure seniors truly get the advantages they're promised. Trending in insurance, Gadget microcoverage and Lloyd's collectible coins. Finally, two lighter developments are creating buzz in the insurance world. Gadget Gap Microinsurance goes viral. A new InsuranceTech startup's product, nicknamed Gadget Gap, has become a social media sensation by offering microinsurance for everyday electronics. For about $5 per month, consumers can insure small personal tech items, think wireless earbuds, phone chargers, fitness trackers, against loss or damage. Importantly, the plan features no deductible and near-instant claims processing via a mobile app. TikTok influencers latched onto Gadget Gap in viral videos, touting how it even covers misplacing your AirPods or dropping a portable charger in a puddle without any out-of-pocket cost. These clips, some garnering millions of views, drove a surge of sign-ups among Gen Z and millennials who often balk at traditional insurance. Within a week of trending, the startup reported thousands of new policies. Industry observers say this highlights a growing demand for microcoverages, bite-sized insurance for specific needs, especially when packaged in a fun, affordable way. It also raises questions: will claims frequency be sustainable at that $5 price point? Will larger insurers replicate this model? For now, Gadget Gap's virality is a marketing win, and it's introducing a younger audience to the idea that insurance can be accessible for even minor everyday mishaps. Lloyd's of London coin resale boom. A niche collectible is fetching big dollars among insurance history aficionados. In 2021, to commemorate a milestone, likely Lloyd's 335th anniversary, a limited batch of Lloyd's of London silver coins was minted and sold for around $89 each. Fast forward to 2026, and those coins are now resurfacing on secondary markets, with asking prices between $350 and $420. Collectors cite the coin's rarity, only a few thousand were produced, and it's tied to the iconic Lloyd's insurance marketplace as driving demand. The coin itself features Lloyd's famous headquarters building design and the year 2021, making it a unique crossover of numismatics and insurance lore. Enthusiasts within the insurance community have been exchanging the coins as gifts or selling them via online auctions, where bidding wars have broken out. While not a mainstream investment, it's a reminder that even the insurance industry has its memorabilia and fans. For those lucky enough to have bought the coin in 2021, its value has quadrupled, outperforming many stocks, not a bad hedge at all, though admittedly far less liquid. And for everyone else, it's a quirky conversation piece about the length and legacy of the insurance market. After all, how many industries can claim a continuous history back to the 17th century, deserving of a silver keepsake? Video script, Insurance Daily News, February 11, 2026. Intro music fades in. Anchor, AI voice. Hello and welcome to Insurance Daily News, spoken by AI, bringing you fast and reliable updates on insurance markets, regulatory changes, claims trends, and more. Today is February 11, 2026, and here are your top stories. 1. Auto insurance rates finally easing, some relief for drivers as Allstate announces auto insurance rate cuts in 12 states. Premiums will drop anywhere from 3% to 11% for many policyholders. This is a big shift after 2 years of steep rate hikes across the industry that had sent car insurance costs to record highs. Why the change? Allstate says claims costs have come down, fewer accidents and lower repair expenses, so they're passing savings back to customers. Analysts say this could be a sign that the auto insurance market is stabilizing after an inflation-fueled spike in premiums. Still, the relief is mostly in states like California, Florida, and Louisiana, which saw especially large rate increases in recent years. For many drivers elsewhere, rates are plateauing rather than falling. But any slowdown in insurance inflation is welcome news for consumers' wallets. Autobodynews.com. 2. FEMA overhauls flood maps. Next up, big changes in flood insurance. FEMA has released new flood maps that re-evaluate flood risks for over 420,000 properties nationwide. Thousands of homeowners, especially in coastal areas, just found out they're now in a higher risk flood zone. That means if you have a mortgage, you'll be required to carry flood insurance, and even if it's optional, your NFIP premiums might go up. On the other hand, about 60,000 properties were moved into lower risk zones, potentially lowering their insurance costs. These updated maps reflect better data about flood hazards and recent mitigation projects. The takeaway: if you live in a flood-prone area, check the new maps. You may need to get flood coverage or could be eligible for lower rates. FEMA gives communities a 6-month window to adopt the maps, so changes will roll out over time. And remember, flooding isn't just a coastal problem, even some inland areas have new changes, so stay informed. Click 2Houston.com. 3. Cyber insurance costs climb higher. Turning to cyber insurance, businesses are facing yet another hike in premiums. Industry reports show rates jumped about 8% since last quarter. The ongoing culprit is the high cost of cyber attacks. We're talking ransomware, data breaches, hacks of cloud services, which continue to pummel insurers and their clients. Because of these losses, insurers are not only raising prices but also demanding stricter cybersecurity measures from companies. Multi-factor authentication, endpoint monitoring, solid backup plans, these have basically become must-haves now. In fact, insurers often won't even cover you if you haven't implemented these protections. Brokers say companies without good cyber defenses are getting hit with hefty 20% to 40% premium surcharges, or exclusions in their policies, which is essentially a tax for weaker security. The good news? If your firm has strong security in place, the market for cyber insurance is stabilizing and you might even see flat or slightly lower renewal rates. But overall, cyber coverage is still expensive, and it's a reminder of how critical it is to invest in cybersecurity to both prevent attacks and keep insurance affordable. AboveTheLaw.com. 4. State Farm sued over roof claims. In ClaimsNews, State Farm is under legal fire for allegedly mishandling roof damage claims. A new class action lawsuit claims State Farm improperly denied many homeowners' claims for roof replacements after severe wind and hailstorms in 2023. The suit argues State Farm used unapproved inspection criteria to essentially label legitimate storm damage as wear and tear, thus avoiding payouts. Over 100 families in Oklahoma have joined similar lawsuits, and there are cases in other states too. State Farm, for its part, strongly denies any wrongdoing. The company says every claim was evaluated fairly and that these are just allegations at this stage. Why does this matter? If you're a homeowner, it highlights how contentious roof claims can become, and why it's important to understand your policy. If you feel a claim was unfairly denied, you do have options like appraisal or even legal action. Insurance regulators are watching this closely. For now, this will play out in court, and we'll keep you updated on any big developments or if State Farm decides to settle. K4.com. 5. Medicare Advantage enrollment hits new high. For the first time ever, Medicare Advantage, those private Medicare plans, now covers over 34 million people. That's more than half of all Medicare beneficiaries. These plans keep growing because they often offer extra benefits original Medicare doesn't, like dental, vision, gym memberships, and rides to the doctor. Many seniors are attracted by the idea of more coverage and often low or even $0 premiums. But the explosive growth of these plans has also brought increased scrutiny. Regulators have raised concerns about aggressive marketing practices used to sell some Medicare Advantage plans in recent years. There have been reports of misleading phone calls and mailers that confused seniors. In response, the government is cracking down with new rules to protect consumers. So if you're shopping for Medicare coverage, be cautious with unsolicited pitches that sound too good to be true. The bottom line, Medicare Advantage plans can be very beneficial for many people, but make sure you understand what you're signing up for, and that your doctors and hospitals are in-network, since these plans do manage your care differently than original Medicare. KFF.org, DJHoldlaw.com. 6. Viral insurance trends, gadget coverage and rare coins. And now for 2 trending stories in the insurance world. First, a new microinsurance product dubbed Gadget Gap has gone viral on TikTok. This is a $5 a month insurance plan that covers small gadgets like earbuds and phone chargers if you lose or break them. And get this, there's no deductible. Influencers on social media are raving that you can basically get your lost AirPods replaced for free. Thousands of people have reportedly signed up in the past week alone. It's a clever way to get younger folks interested in insurance by covering the everyday things they care about. Time will tell if the company can sustain this model. They'll certainly be paying for a lot of lost earbuds, but for now it's the talk of InsuranceTech circles. Meanwhile, a more old-school item is making waves. A limited edition Lloyd's of London silver coin minted in 2021 has become a hot collector's item. Originally sold for under $100, these coins are now reselling for over $400 among insurance buffs. Only a few thousand were made to commemorate the famous insurance marketplace, and it seems the rarity, plus a bit of nostalgia, has driven up the price. It's not every day you see a piece of insurance memorabilia quadruple in value. For those who snagged one early, that's a nice return. And for the rest of us, it's a fun reminder of the rich history behind the insurance industry, and maybe a sign to check your attic for any hidden collectibles. Closing. That's it for today's Insurance Daily News Update, where we covered everything from auto premiums and flood maps to cyber insurance, legal battles, and even viral gadget insurance. Thanks for listening. If you found this helpful, be sure to subscribe for your daily dose of insurance and risk industry news. Remember, this content is for informational purposes only and not official financial or legal advice. Always consult a professional before making insurance decisions. Stay safe, stay informed, and we'll catch you next time. Music fades out. Tags: Insurance News, Insurance Market Update, Auto Insurance Rates, FEMA 2026 Flood Maps, Cyber Insurance Trends, State Farm Lawsuit, Medicare Advantage 2026, Insurance Daily Briefing, Insurance Spoken by AI, Risk Management News, Insurance Claims Update, Insurance Regulation, Viral Insurance Products, Insurance Industry Analysis, Insurance Market Trends. Sources. Report Summary. 1. Allstate announces major auto rate reductions in 12 states. Allstate confirmed it will lower auto insurance premiums across 12 states following improved loss ratios and reduced claim severity. Reductions range from 3% to 11%, depending on the state. Analysts say this signals stabilization after 2 years of aggressive rate hikes across the industry. 2. FEMA updates flood maps for 2026 cycle. FEMA released its latest flood insurance rate map, firm, updates, impacting over 420,000 properties nationwide. Thousands of homes in coastal regions were moved into higher risk zones, increasing required NFIP premiums. Conversely, 60,000 properties were downgraded to lower risk categories, reducing annual costs. 3. Cyber insurance premiums rise again. Cyber insurance rates increased 8% quarter over quarter, driven by ransomware severity and cloud infrastructure attacks. Underwriters are tightening requirements around MFA, endpoint monitoring, and incident response plans. Brokers report that companies without documented security controls face 20 to 40% surcharges. 4. State Farm faces class action over roof claims. A new class action lawsuit alleges State Farm improperly denied roof damage claims by using unapproved inspection criteria. Plaintiffs argue the insurer systematically rejected wind damage claims after 2023's severe storm season. State Farm denies wrongdoing and says its methods comply with state regulations. 5. Medicare Advantage sees record enrollment. CMS reported Medicare Advantage enrollment surpassing 34 million, the highest in program history. Growth is driven by expanded supplemental benefits, including dental, OTC allowances, and transportation. Some watchdog groups warn that aggressive marketing practices may face regulatory scrutiny in 2026. 6. Viral insurance product of the day, Gadget Gap Micro Coverage. A new $5 per month micro insurance plan covering lost earbuds, chargers, and small electronics went viral on TikTok. Sign UPS surged after influencers highlighted that no deductible feature. Early resale angle, promotional bundles including branded cases are reselling for 3 times retail. 7. High-value resale item, 2021 Lloyds of London commemorative coins. A limited run of Lloyds of London silver coins originally priced at $89 now sells for $350 to $420. Collectors cite the coin's rarity and insurance industry historical significance. Formatting data. Label SEO-optimized tags, copy/paste ready. InsuranceNews, Insurance Market Update, Auto Insurance Rates, FEMA 2026 Flood Maps, Cyber Insurance Trends, State Farm Lawsuit, Medicare Advantage 2026, Insurance Daily Briefing, Insurance Spoken by AI, Risk Management News, Insurance Claims Update, Insurance Regulation, Viral Insurance Products, Insurance Industry Analysis, Insurance Market Trends. Scroll video description, SEO rich plus disclaimer. Insurance Daily News Spoken by AI delivers fast, reliable updates on insurance markets, regulatory changes, claims trends, and risk industry developments. Today's report covers all states' auto rate reductions, FEMA's 2026 flood map updates, rising cyber insurance premiums, State Farm's new class action lawsuit, record Medicare Advantage enrollment, and 2 trending items, the Gadget Gap micro coverage plan and Lloyd's commemorative coin resale boom. Disclaimer: this content is for informational purposes only and is not legal, medical, financial, or official advice. Do not treat anecdotal stories or commentary as guidance. Artist palette thumbnail concepts, text only for A/B/C testing. If you want actual generated images, just say, generate thumbnail A/B/C. Thumbnail A, insurance market shift. Shield icon plus rising/falling arrows. Auto rates drop, cyber rates rise. Navy/white/gold newsroom palette. Thumbnail B, flood map shakeup. FEMA map icon. 2026 flood zones updated. Blue/teal geographic theme. Thumbnail C, claims and lawsuits update. Gavel plus house icon. State Farm sued, claims under fire. Clean, high contrast headline layout. Shield Insurance News Ultra Deep Dive Report. February 12, 2026. Script style, institutional analysis. Macro opening, the insurance market enters a transition phase. Narrator. The insurance industry is entering a transitional phase following one of the most volatile underwriting cycles in modern history. From 2021 through 2024, insurers faced a convergence of inflation shock, litigation expansion, climate-driven catastrophes, supply chain disruption, and rapidly evolving cyber risk. The result was aggressive repricing across nearly every major line of business. The developments covered in today's report illustrate what happens after the shock phase ends: selective normalization, structural recalibration, and increased segmentation between high-quality and high-risk exposures. Keycap 1: Allstate's auto rate reductions, what this really signals. Deep context. Allstate's expansion of auto insurance rate reductions into 18 states is not merely a consumer-facing pricing event. It is a capital signal. Auto insurance pricing follows underwriting cycles driven by claim frequency, claim severity, repair inflation, legal system costs, capital adequacy, competitive positioning. From 2022 to 2024, carriers aggressively raised rates to correct unsustainable combined ratios caused by parts shortages, labor inflation, and increased vehicle complexity. Why reductions are now possible? Several forces converged in late 2025. Repair supply chains normalized. Frequency declined as driving behavior stabilized. Telematics sharpened risk segmentation. Prior rate increases finally earned through the book. Capital buffers recovered. Allstate's reductions ranging from 2% to 12% are surgically applied, not broad-based. Critical insight. This is not a market-wide softening. It is precision repricing. States with favorable tort environments and improving loss experience benefit. Others do not. Strategic implication. Allstate is prioritizing retention stability over aggressive growth while signaling financial strength to regulators and investors. Keycap 2: FEMA Risk Rating 2.0, Flood Insurance Enters a Data Age. Deep context. FEMA's updated 2026 flood risk projections are part of a multi-year transformation of the National Flood Insurance Program. For decades, flood insurance pricing relied on static maps and broad zones. Risk Rating 2.0 dismantles that model. What changed? Risk is now assessed using property-specific hydrology, distance to water, flood type, riverine, coastal, rainfall, surge, replacement cost, elevation relative to expected flood heights. This update affects over 600,000 properties nationwide. Regional divergence. Coastal Florida, Louisiana, and the Carolinas saw premium increases due to refined storm surge modeling. Inland Midwest properties benefited from updated river flow data and reduced loss projections. Systemic consequence. Flood insurance is no longer a collective subsidy. It is becoming individualized risk pricing, mirroring private market catastrophe underwriting. Long-term impact. While actuarially sound, this shift raises affordability and participation concerns, particularly for legacy policyholders facing steep adjustments. Keycap 3: Cyber Insurance AI turns risk into a moving target. Deep context. Cyber insurance is experiencing one of the fastest structural transformations of any insurance line. Premiums rose 9% quarter over quarter, driven by the industrialization of cybercrime through artificial intelligence. How AI changed cyber risk. Phishing campaigns scale instantly. Malware adapts in real time. Credential harvesting accelerates. Attack attribution becomes harder. Incident costs rise non-linearly. Underwriting evolution. Insurers no longer rely on static questionnaires. They now require verifiable security controls, including endpoint monitoring, mandatory MFA, incident response playbooks, vendor risk oversight. Organizations lacking baseline controls face 25 to 40% surcharges or non-renewal. Key shift. Cyber insurance is no longer risk transfer alone, it is behavior enforcement. Keycap 4: State Farm Litigation Claims Handling Under a Microscope. Deep context. Litigation alleging improper denial of wind and hail claims reflects a broader industry challenge: claims consistency in catastrophe environments. Plaintiffs allege the use of unapproved inspection criteria, resulting in systematic denials following the 2025 storm season. State Farm denies wrongdoing and asserts regulatory compliance. Why this matters: industry wide. Claims handling is now one of the largest sources of insurer liability, often exceeding catastrophe losses themselves. Courts increasingly scrutinize inspection methodologies, vendor consistency, internal guidance documents, pattern of practice allegations, strategic consequence. Even without an adverse ruling, litigation pressure drives higher loss adjustment expenses, reserve uncertainty, and regulatory oversight. KeyCap 5 Medicare Advantage scale meets scrutiny. Deep context. Medicare Advantage enrollment surpassing 35 million members reflects a structural shift in U.S. healthcare financing. The program's growth is driven by supplemental benefits expansion, zero premium plans, simplified coverage experience, aggressive marketing. Why regulators are watching. Rapid growth brought increased consumer complaints regarding marketing clarity, plan switching confusion, benefit misrepresentation. Systemic issue. Medicare Advantage now represents a material portion of federal healthcare spending, intensifying oversight without slowing demand. KeyCap 6 MicroShield, microinsurance goes viral. Deep context. The viral success of a $4 per month microinsurance product covering small electronics highlights the evolution of insurance distribution. Why it worked. Narrow coverage scope, clear value proposition, influencer-driven trust, low cognitive friction, embedded purchase behavior. Sign UPS surged 300% in 48 hours, a speed traditional insurance cannot match. Strategic signal. Insurance increasingly behaves like consumer technology when friction is removed. KeyCap 7 Lloyd's Silver Coin, insurance as collectible asset. Deep context. The resale surge of a limited edition Lloyd's of London Silver Coin reflects a niche but telling phenomenon: institutional nostalgia monetized. Originally priced at $89, resale values now range from $360 to $420. Why value spiked. Limited mintage, historical branding, collectible crossover with finance culture, renewed interest in insurance heritage. Insight. Even risk institutions generate secondary markets when symbolism meets scarcity. Final synthesis: what this all means. Narrator. Across auto, flood, cyber, health, and consumer microinsurance, one pattern emerges. Insurance is becoming more precise, more segmented, and more behavioral. Risk is no longer averaged. It is measured. Coverage is no longer bundled. It is curated. And underwriting is no longer static. It is continuous. This is the insurance market of 2026. End of Ultra Deep Dive Report. Insurance Industry News, February 12, 2026. AI disruption: Insurify's ChatGPT app rattles insurance industry. A new artificial intelligence tool is shaking up the insurance world and sparking turmoil among traditional brokers. Online insurance marketplace Insurify announced the launch of a groundbreaking ChatGPT-powered app that lets consumers compare and shop for auto insurance through a conversational AI interface. The app, one of the first 100 third-party apps in OpenAI's ChatGPT plugin store, taps into Insurify's database of 196 million auto insurance quotes and 70,000 customer reviews to provide personalized coverage options and carrier recommendations directly within a chat session. According to Insurify's CEO Snejana Zakaria, buying car insurance can now be as simple as having a conversation, as the app allows drivers to ask questions in plain language, receive tailored quotes, and read real customer reviews, all without leaving the ChatGPT platform. The goal is to streamline one of the most tedious consumer chores, shopping for insurance, by bringing it into the era of conversational AI. With our new ChatGPT app, "We're redefining the insurance shopping experience by making it feel as simple as having a conversation," Zacharias said, emphasizing that the tool combines AI with Insurify's extensive quote data to quickly match drivers with policies that fit their needs and budget. Users can even jump from the ChatGPT comparison to finalize their purchase with a licensed Insurify agent seamlessly. This first-of-its-kind InsuranceTech app demonstrates how AI might soon play a central role in insurance distribution, but it's also causing shockwaves in the traditional brokerage sector. PRNewsWire.com. In the aftermath of Insurify's app launch, U.S. insurance broker stocks plunged on fears that AI-driven platforms could upend the industry. On February 9, the S&P 500 Insurance Index dropped 3.9%, its worst single-day fall since October, and some brokerage giants saw their share prices tumble by nearly double digits. Willis Towers Watson stock plummeted 12%, its steepest one-day decline since 2008, while Arthur J. Gallagher fell 9.9% and Aon plc lost 9.3%. Analysts pinned the sell-off on investor anxiety that tools like Insurify's ChatGPT app could disintermediate insurance brokers by automating insurance shopping. "The insurance broker stocks are getting hammered," observed Bloomberg intelligence analyst Matthew Palazzolo, noting concerns that Insurify's AI-driven platform, along with new automation tools from AI startups like Anthropic, may be a threat to some consulting businesses of insurance brokers. The fear is that advanced AIs could handle tasks like policy comparisons and risk assessments that clients traditionally relied on human brokers for, potentially cutting into brokers' commissions and market share. Straitstimes.com. However, industry experts urge caution before writing off human brokers entirely. Palazzolo and others suggest these AI tools might become a force multiplier rather than an existential threat, boosting efficiency for brokers who adapt, instead of fully replacing the human element. They point out that commercial insurance, complex risk advising, and claims advocacy involve personalized, nuanced services that automated tools cannot yet replicate. Brokers could even adopt AI themselves to enhance client service. Still, the dramatic market reaction underscores the insurance sector's recognition that AI-driven innovation is here, and it's moving fast. Insurify's ChatGPT app went live on February 3, and within a week it sparked a reshuffling of market value in the brokerage space as investors recalibrated expectations. The episode highlights a broader trend: insurance technology, InsuranceTech, is rapidly evolving, and incumbents may face disruption if they don't evolve in tandem. Straitstimes.com. Cyber insurance market sees premiums drop amid rising attacks. A new industry report reveals a puzzling trend in cyber insurance: premiums are falling even as cyber losses mount. Insurance broker Lockton released a market update showing that cyber insurance premiums declined by an average 11% in 2025, despite a dramatic increase in cyber incidents and claims. The UK's National Cybersecurity Centre recorded a 129% spike in nationally significant cyber incidents in the 12 months up to August 2025, including some of the worst ransomware attacks on record. Yet over that period, greater competition and appetite from insurers drove cyber policy rates down by roughly 10 to 11% on average for companies renewing coverage. Lockton's analysts call it a rare divergence between underlying risk and insurance pricing, as one would normally expect a surge in cyber losses to drive higher premiums. Instead, the cyber insurance market has remained soft, good news for insurance buyers, at least for now. Shout.com. Several factors are contributing to this counterintuitive soft market. New entrants, including managing general agents, MGAs, syndicates, and insurers, have been pouring fresh capacity into cyber insurance, intensifying competition and keeping prices in check. At the same time, many insurers have expanded coverage offerings, adding benefits like broader anyone claim aggregates and business interruption extensions to attract customers. According to Lockton, the result is wider coverage and continued price competition even after some of the worst cyber incidents in recent history, including major ransomware attacks that significantly impacted companies' bottom lines in 2025. One UK cyber attack in 2025 had such a direct, material impact on consumers that it dramatically raised public awareness of cybersecurity risks. Overall, claims frequency jumped about 20% last year, primarily data breaches, and while ransomware made up just 16% of incidents, it accounted for roughly 75% of total claims payouts. In other words, ransomware is less frequent, but its impact is massive, the report noted. Advertisem, shout.com, advertisem, shout.com, advertisem, shout.com. Lockton's cyber experts caution that today's bargain premiums may not last. The company's head of cyber and technology, Carlo Marengo, in an analysis reported by Advertisement Shout, said that cyber insurance remains a buyer's market in 2025 to 26, with insurers willing to write new risks and policyholders enjoying historically competitive rates. But he warned that the steady premium decline may soon bottom out. Historic claims, particularly in the United States, could pose a challenge to the market as losses accumulate in 2023 and 2024, Marengo explained, adding that this could pressure profitability and lead to another volatile pricing period by 2027. In other words, if the recent wave of cyber losses starts to hit insurer financials, the current soft market might harden again with rate increases or tighter coverage in a few years. For now, however, insurers' choice and competition mean premiums remain low even as incidents rise, making it a good time to buy cyber insurance for many organizations, Marengo noted. Risk managers are advised to seize the moment to secure broad coverage at favorable rates, but also to thoroughly re-evaluate their coverage limits and cybersecurity postures while prices are advantageous. Advertisem, shout.com, advertisem, shout.com, advertisem, shout.com. Legal and climate update: Texas anti-woke law overturned amid ESG debate. In regulatory news, a court decision in Texas could reverberate across states and the insurance investment landscape. A federal judge in Texas struck down the state's 2021 law that blacklisted woke financial firms, like BlackRock and other asset managers, for considering environmental, social, and governance (ESG) factors in investments. The law, known as the Energy Discrimination Elimination Act, had required state agencies to divest from firms deemed hostile to fossil fuels. The judge ruled the law unconstitutional, saying it violated free speech rights by punishing companies for their climate change policies and affiliations, a home court loss for Texas, as one attorney put it. Texas officials plan to appeal, but experts say the ruling provides a roadmap to challenge similar anti-ESG laws that have been passed in at least 14 other states including Oklahoma and West Virginia. The decision's challenge to the idea that considering climate or ESG factors is purely political clears the way for many of these laws to be contested, noted Brian McGannon of U.S.